Another lesson. In this video, we're going to look at a question that was tested in August 2023, financial management, and we're looking at question number 4. The question reads, financial planning is one of the most crucial steps for any person, regardless of whether they earn any income or not. While many people understand the importance of financial planning, it is still one of the steps that are postponed or skipped. With regard to the above statement, summarize 4 benefits of financial planning to an individual. Now, the first benefit of financial planning is that set and achieve financial goals. By this we mean that financial planning can help someone to identify financial goals and create plan to achieve them. Two, they reduce financial stress. By this we mean that can help to reduce financial stress by giving you a sense of control over finance. Three, make better financial decision. This one can say helps to make better financial decisions by providing information and tools needed to make informed choices. Number 4, protect your assets. Protect your assets. This will mean that help you to create sound financial plan and making sure have the right insurance cover, insurance cover. And finally, we say they help someone to plan for the future. the future. With good financial planning, can help one to plan for the future, e.g. retirement, college, and other long-term goals. So those are the benefits of financial planning. We go to part B. Describe 4 forms of dividend payments that a company could use while making the decision. How can company pay dividends? The first and most common one is the cash dividends. This is the most common one. So we have cash dividends. Cash dividends. Here we mean that this is the most common form of dividends payment. Dividend payment. The company transfer cash to the shareholders account, Another way you can receive dividends is stock dividends. Here we mean that this gives shareholders additional shares of the company stocks. Companies do not have to pay out cash. Another way a company can pay dividends is property dividends. Here we mean that this type of dividend gives shareholders physical assets such as land and building. Finally, we look at liquidation dividends. Number 4, we look at liquidation dividends. Here we mean that this type of dividend is paid out when the company is winding up, when the company is dissolving. It is a way for the company to distribute its remaining assets, to shareholders. So those are the major ways companies can distribute dividends. We look at part C. We are told that Zora Limited Security Market, Zora Limited, a security market listed company, has the following recent financial information: profit after tax, dividends, statement of financial position was as this, non-current assets 89 to 500, current assets 187, and they're in thousands. That means these are millions. Financial analysts have forecast that the dividends of the company will grow in the future at the rate of 4%, that is G. This is slightly less than the forecast growth rate of the profit after tax of the company, which is 5%. Considering the risk associated with the expected earnings growth, earnings yield of 11% per annum can be used for various valuation purposes. Zora Limited has a cost of equity of 10% per annum, and before tax cost of debt is 7% per annum. 8% bonds will be redeemed at par in 6 years' time, and the company paid tax at annual rate of that percent per annum. The ex-dividend market shares price of Zora Limited is 8.5 per share. We are supposed to look at the net asset value. Net asset value. We are supposed to calculate the value of Zora Limited. So we are looking at Zora Limited using the net asset value method. So value per share here simply needs us to know the total equity divided by shares outstanding. Total equity you can get from the financial statement. Here, reserve plus ordinary shares, 735,000. Total equity can be obtained from, this is 735,000 divided by the shares, which are 120,000. This gives you 6.125. 6.125. The shares outstanding are still in the question. Ordinary shares is 1 shillings per share. So if you divide this one by 1 shillings, that means these are the number of ordinary shares. Good. Dividend growth method. Dividend growth method, we need first of all to get dividend per share. Dividend per share. This will be 60,000 divided by 120,000. This is 0.5. Why is 60,000? It is in the financial statement here. You have been told that the dividends here is 60,000 and the number of shares here is 120. So get dividend per share. Then the growth method, we know value is D naught into 1 plus G divided by R minus G. So in this case is 0.5, which is our dividend, into 1 plus 0.04. The growth rate was 4%. Divided by 0.10 minus 0.04. This is 0.52 divided by 0.06, and the value is shillings 8.67. That is it about dividend growth method. We did this one when we are doing valuation of financial assets. Earning yields. So we need earnings per shares. Earnings per share. So in this case, we have the total earnings here is what? What are the total earnings? Look at total earnings. We have profit after tax is 99,900. So these are the total earnings. We divide by the shares. Here we have 99,900 million. Divide by 120,000. This gives you 0.9. 0.83. This is it 120,000? Divided by 120,000? No. These shares here will be 120 million. 120 million. These are millions. Look at these are millions. Even these ones are millions. So 120 million. Divide by 120 million. Not 120,000. 120 million. So this gives you 0.8325. So now do the value using the growth rate, 0.8325 into 1 plus 0.05 divided by 0.11 minus 0.05. This gives you 0.874125 divided by 0.06, and this is shillings 14.57. This figure 5% and 11% have been given in the question. You are told that considering the risk associated with expected earning growth, earning yield is 11%. Already you've been given that. And then you are told that the company profit after tax earnings, which is 5% per annum. So those figures have already been given. Now, next part, you are told that using the information in C above, calculate the weighted average tax after tax cost of capital WACC using the market values. So you have to know how much are the values of the debt and equity. So let's first of all look at after tax cost of debt, which is 80% bond. This is 181 minus 0.3, which gives you 5.59. Then we look at market value of ordinary shares. Market value of ordinary shares, we have 120,000. We divide by 1 times 8.50. This gives you 1020, and these were also in millions. Remember, this one were in millions. So get this one gives you 1020 millions. Now, so what are the market values of bonds? It's already given in the question. Market value of bonds is 180. Market value of bonds, shillings 180,000. What is the total value of? There is also market value of bank loan. So bank loan we have 60,000. So if you add all this, it should give you the total value of capital. Total value of capital should be, if I remove thousands, all these were in thousand. If I worked, I remove this one so that I work with them in thousand. They are going to give me the same thing. 1020 plus the next one is 180,000 plus 60,000. This will give me the total value of capital as 260,000. So what about cost of debt? Cost of debt, because here we are talking about equity, and cost of debt will be 7 into 1 minus 0.3. This gives you 4.9%. So let's now calculate our WACC. Our WACC will be 10 times 1020 divided. You see, you're looking at the percentage here. Plus 3.6 times 180 divided by the total is 1,206,000 plus 4.9 times 60 divided by 126. So when you work this out, this part here, you are taking this is the weight of the ordinary shares, the weight of each and every item has been captured here. So here we are going to have 8.10% plus 0.8% plus 0.23%. So your work will be 9.13%. Now let me mention something here. If you look at this question, you have been given these figures here. You have been given these figures here. You need to use them to get the value of each and every item. Like in this case, we have had to calculate the value of bond. If you look at this, I had to calculate the value of bond 5.59. Then I had to calculate the market value of ordinary shares. Then the value of bond, this is 180. When you take 120, 180 plus this gives you the total capital. So these fractions here you're seeing are the weights. Yeah. Like this one is the cost of debt. Debt is 6,000. 6,000 over 1260 times the cost of debt. Yeah. Now this is 180 is the market value of bonds. Yeah. And then this one 120, this will be the market value of ordinary shares. And the ordinary shares are going at 10 shillings 10. The cost of equity is 10% here. I've already been told here the cost of equity is 10%. So that is it. That's how we calculate the work in this question. That's how we calculate the work. And we are going to stop there. When we come in our next video, we shall look at another question. Goodbye.